Good evening, everyone. We'll wait for 2 minutes and then we'll resume with today's session. Let me send a message in the group that I'm live. Okay, I've sent a message in the group that I'm live. We'll wait for a minute more and then we will start off. I'll just get some water and come back in the meanwhile, friends. Good evening, Feba, Janani, Mahesh, Shreya, Gopi Krishnan, Shabnam. Good evening, all of you. We'll just wait for one more minute and we'll start off. Good evening, Christina, Guru. Good evening, everyone. Yes, friends, I'm back and I believe we can start off now. I believe all of you have joined in, friends. Yes? All right. Okay. Friends, one more request I have for all of you. Please attend my classes live itself. I know some students had messaged me yesterday that they will not be able to attend live. If it's absolutely genuine reason, it's absolutely fine. But please make sure that you attend the recorded lectures next day itself. All right. Do not delay beyond that because then it will start gets, procrastination and then it will go beyond your control. I don't want that to happen. So I request you all, please attend my classes live itself. Okay. So today is 21st May, May 21. We were doing basics yesterday, right? Today we'll start off with a chapter called as security valuation. Okay. Even before I proceed with this, can we revise whatever we learned yesterday, friends? One minute. Don't know what's happened there. Okay. That's something else. We'll ignore it for time being. All right, friends. So shall we revise whatever we learned yesterday, friends? Come on. I would like to randomly catch one or two people for the interactive part. Are you ready? All right, whom do I catch first? Berlin Jane, please unmute and tell me a hi. Berlin, are you there?
Hi, sir. Can you hear me?
I can hear you, Berlin. Berlin, I believe you attended my yesterday's class, correct?
Yes, sir, I did.
I can ask you a few questions on the concepts that we took yesterday. Is that okay with you?
Yes, sir. It's okay with
All
me.
right, it's absolutely fine if you're unable to answer also. All right, it's just an objective is very clear that we just learn it together. That's all. Okay. So we started with the concept of NPV. What is the full form of NPV?
Net present value.
How do you calculate NPV?
NPU is the present value of inflows minus the present value of outflows.
Okay. Other students at this time, please try answering in your mind. Okay. That is the objectives. Basically to give you a revision of what we learned yesterday. Okay. Fine. Fantastic. Now tell me if NPV is positive, will you accept the project or reject the project?
We will accept the project, sir.
Okay. NPV negative means?
Reject the project.
How do you calculate cash flows?
Cash flow is PAT plus depreciation minus uh, uh, capex minus additional working capital.
Fantastic, fantastic, fantastic. Okay, let me go to the next part now. Okay, then we learned about discounting factor. What do you mean by discounting factor?
It's the investor's expectation.
All right, investors' expectation. So basically, whatever returns you get from your father's business. That's how I have explained to you in my class. Correct? Right.
Yes, sir.
Now I'll go to the next thing. I think after that we learned about capex and additional working capital. How do you work out capex?
Capex is the addition in the fixed assets.
Fantastic. What about additional working capital?
It is the addition in the current assets minus the addition in the current liabilities.
Fantastic, fantastic. I think then we learned about how to value an asset. Tell me, how do you value any asset?
The value of any asset is the present value of future cash flows that the asset is able to generate.
Fantastic, fantastic. I think that's it. Then we learned about IRR. What do you mean by IRR?
IRR is a rate. Are you asking the full form or the meaning?
Yeah, yeah, the meaning of IRR.
It is a rate at which the NPV becomes zero.
Fantastic, Berlin. Everyone, please give her a clap. I know you cannot hear us, but you have done a great job. You have answered all the questions brilliantly. Thank you so much, Berlin.
Thank you,
Thanks a
sir.
lot.
Thank you, sir.
Right. So, friends, I believe you're all clear with these concepts. We learned about NPV, we learned about cash flow, discounting factor, we learned about IRR, we learned about how do you value an asset. Am I right? So, today we are going to start with a proper chapter now. Are you all ready with that, friends? So, we'll start with the first chapter, which is called as security valuation. Okay. Friends, I will break this chapter into two parts mainly. All right. Part number one is what I will call it as bond valuation. And part number two is what we will call it as share valuation. Okay. Can you please put this chart in your books now? And yes, I need one or two support people to let me know how the classes are going or the pace of the class. So whom do I catch today? Let me just see. Farha Samreen, please tell me a hi. I think she's not there. Shivakumar, please tell me a hi.
Hi, sir.
Okay, Shivakumar, whenever you're done writing, just message and tell me that you're done. Okay.
Okay, sir.
Okay, one more person I just want. Adarsh Bhaskaran, please tell me a hi. I think he's unable to unmute. Akshaya, please tell me a hi. Okay, Adarsh,
Hi, sir. Hi. Hi. Hi.
Adarsh, okay, I wanted you to unmute and tell me a hi. Okay, Adarsh, whenever even you're done, tell me that you're done with the session. Okay. So I think when you, I've nominated two people. When both of you say you're done, I will go to the next part. All right. Fine. I think by the time you would have done writing this in your books, correct? Can I go to the next part now? Okay. So friends, we are starting with the first main chapter for all of you, which is called as bond valuation. So friends, please interact and tell me. I want some interaction. So you're all free to unmute yourself. That's why I don't put that restriction. You can unmute yourself and interact with me. That way the classes will become more lively. Tell me, what do you mean by the word bond? You don't have to chat. Unmute and speak directly. It's okay if you go wrong. What exactly do you understand by the word bond? Yes. It's an instrument. Yes, Satya. What type of instrument is it? Excellent, friends. It is actually a debt instrument. Friends, debt instruments can be, for example, I'll show you. One of the examples of debt instrument is debentures. Am I right? There are two. I'll just give you two examples. There are multiple more. I'll just give you two examples. One is debentures, and other one is bonds. These are normally issued by private entities. So basically, companies like Reliance, Tata, Birla will go for debentures. Bonds are normally they are issued by government. So now tell me which is having a lower risk, bonds or debentures?
Bonds.
Bonds are having lower risk. We can say it is risk free in a form because it is guaranteed by whom, friends? It is guaranteed by the government. All right. Can you please put this chart in your books now, all of you? Once you are done writing, please unmute and tell me, okay? My support people, don't forget. Others will wait for you then.
Done.
Done? Fantastic. All
Yes.
right. So I'll go to the next part now. Okay. So I think you're clear with what exactly is a bond and what exactly is a debenture. I'll show you practically. As I told you on the first day, we'll be having some practical learning also here. I can show you practically how bonds actually operate. I think it is a part of coin in Zerodha. Let's just recheck and confirm. Earlier it was in part of coin. I'm not sure if they have moved out now. I have an account in Kite, so I'll keep that account and I will do it. 1 minute. One moment, I'll just log into this and show you. 883769. 883769. Okay. So friends, I've just logged into my coin platform. In Zerodha, they have got two platforms. One is coin, other one is kite. All right. Here, normally they used to have bonds. They have removed it now. Now it is mutual funds. National pension scheme is there, NPS is there, insurance is there, and there's a dashboard. Let me just cross check if it's available here. They have moved it from coin. Maybe they have moved it to kite or somewhere else. Let's just try it in kite also, friends. Give me a minute. Seven, eight, 7, 4. Let's check if it's available here. Earlier, okay, here let me just go and check orders, holding, positions, console. Let's go to console. No, it's all only equity. They have removed bonds, friends. Earlier, bonds used to be available here. Let me just see if, let me check where else I can find out the bond related, documents, and then I will get back to you. It was earlier a part of coin, but I don't know why they have removed it now. So there we used to get two types of bonds. One will be government bonds and the other one is going to be what? Corporate bonds. These were the two types of bonds. All right. So now let me give you a few examples of a bond. Okay. So you can write down example NHAI bonds. What is the full form of NHAI? National Highway Authority of India. So NHAI bonds, when they issue, normally the bonds will have a face value. Let us assume the face value of a bond is 100 rupees. Then they will have something called as a coupon rate. Let us say the coupon rate is 10%. All right. Friends, now tell me, this 10% of coupon rate, will it be on the face value or will it be on the market price?
Face value.
Face value.
It is always on the face value. Even in case of debenture, the interest is paid on the face value itself. Everybody clear? So the coupon rate is going to be how much? 10% is going to be on the face value. All right. Apart from that, they will give you a life. Let us say the life of the bond is turning out to be around 5 years. At the end of the 5 years, you will have a redemption value. That is, at the end of 5 years, let us say the bond is redeemable, or they are going to sell back the bond at what price? 120 rupees. Then they will have one more terminology over here, which is called as yield. Let us assume the yield is turning out to be 12%. Friends, what is the meaning of the word yield? Friends, yield is nothing but investors' expectation. Earlier, we have used the same word for another terminology. What was that other terminology? Can you tell me?
Discounting factor.
Discounting factor, exactly. So discount factor is investor's expectation. Yield is also what? Investors' expectation. So I will explain to you in more elaborate manner. For time being, just write down this one example, because with this example, I will explain to you the entire bond terminology. Suhail, I'm not taking class for SEMP as of now. I'm completely focusing all my energies into inter FM and final AFM. Plus, I'm into business valuations. So my complete life is into FM. So that's why I thought of sticking to that now. All right. Are you all done writing this, friends? Others done? Others, don't send a message in the chat box. Just unmute and tell you're done. Okay. Because sometimes I miss out on
Sir,
the
done.
messages.
And sir,
Thank you. Thank you, others. Thank you so much. Right. Are you all done writing so far? So what do you exactly mean by this? Okay, we'll just put up one more point which I did not mention earlier, which will be called as the issue price. Let us say the issue price is turning out to be 90 rupees. All right. Just write down that also. I will now tell you the logic of this entire thing that I have given you over here. Okay. The logic goes like this, that the face value of the bond is actually how much? Is 100 rupees. But today it is issued at what price? 90 rupees. All right. As an investor, we will receive 10 rupees every year for the next how many years? For the next 5 years. Okay. At the end of 5 years, I will receive redemption value of how much rupees, friends? How much will I get as redemption value at the end of 5 years? I think I'll get a redemption value of 120 rupees. Am I right? All right. And my father gives me how much percent return? 12% return. Hence, that is my expectation. This is the meaning or the logic of what we just now spoke. Write down this, and I hope you are clear with the logic here.
Done, sir.
Done? Fantastic. Can I go to the next part now? All right. So friends, I think you're clear with the logic of what exactly is a bond. Okay. Now inside this, I will write down the next concept heading, different types of bonds. Friends, there are mainly three types of bonds. All right. First type of bond is called as regular bonds. Second type of bonds are called as zero coupon bonds. And the third type of bonds are what we call it as perpetual bonds. Everyone, please repeat with me. Wait, Gopi, you're still writing? Sorry, Gopi, let him finish writing, friends. Fine, friends. I believe you're all done writing. Okay. So, friends, once again, repeat with me. There are three types of bonds: regular bond, zero coupon bond, and what is the last one? Perpetual bonds. Friends, regular bonds is what I told you. Regular bonds will have limited life, it will have proper redemption value, and it will be having coupon amount also. That is what we call it as regular bond. Now you tell me using your common sense, what will happen in case of zero coupon bond, friends? What will be the difference over here? It will have the same limited life. It will have redemption value, but will it have a coupon over here? Okay, there will be no coupon. Such bonds are called as what? They are called as zero coupon bonds. Now tell me, what do you mean by perpetual bonds? Here you will have unlimited life. So once you have unlimited life, that means you will have no redemption value at all. No redemption value. And the last point over here will be, there will be coupon received forever. So these are the three types of bonds that we will learn, friends. Regular bond, zero coupon bond, and what? Perpetual bond. Can you please write down this in your books now? Shiv Kumar, you have a doubt. Is the zero coupon bond same as deep discount bond? One way, yes. Zero coupon bond is a bond that the name is called for multiple things. Treasury bill, deep discount bonds, multiple names used. All of them are nothing but zero coupon bonds only. Suhail, I'm sorry, I didn't get your point. You cannot sit more than 2 hours. Live class, okay, but recorded plus study, max you can invest 3 hours. Suhail, can you please unmute and speak to me? You're talking about the time available for your studies, is it? For AFM? So, well, absolutely no issues. We have 3 hours of class. You attend these 3 hours of class. Only request, if possible, morning after you wake up, you can spend 15 minutes more for reading. Then only the concept book, not even the problem book. And I will not have class on Friday, Saturday. These 2 days, if you can keep the same time aside, 3 hours daily, and you can work out the same problems, you are through. All right. Consistency is the key. Daily 3 hours, bit by bit. Are you all done, friends? Adarsh?
Done, sir. Done, sir.
All right. So, friends, I think you're all clear with the concept of regular bond, zero coupon bond, and perpetual bond. Now, let me go to the next concept. How do you value a bond? Everyone interact and tell me, how do you value any asset? Unmute and tell me.
Present value of future cash.
Present value of future cash.
Present value of future
Value of
cash.
future cash flows. So now tell me, if an asset is valued using present value of future cash flows, even a bond will be valued using what? Present value of future cash flows. So I'll write down over here, value of a bond is present value of future cash flow. So now I will give you a breakup behind this. Okay. I told you there are 3 types of bond. What is the first bond we spoke about? Regular bond. Everyone now tell me, what are the future cash flows in case of regular bond?
Coupon amount and
Redemption
redemption.
and
Coupon and redemption
amount.
value.
So here it will be present value of coupon amount plus what? Redemption value. Am I right? Okay, now tell me, what if we are speaking about zero coupon bond? Somebody is
present
playing
value of
piano
redemption.
there. Sudhin, are you playing piano? Okay, now what about zero coupon bond? Here it is going to be the present value of what? Only the redemption value. Fantastic. Now tell me, what about in case of perpetual bond?
Coupon amount.
Fantastic, friends. I hope you have understood the logic of this now. Present value of coupon amount received towards infinity. Now, how to take the present value of infinity, we will learn it later on. Can you write down till here in your books first?
Sir, done, sir.
All right. Are you all done? Wait, some are still writing. Let them finish. So then absolutely fine. No worries at all. Relax, relax, everyone. Please write down. I will not go fast. I'll make sure all of you have thoroughly completed. We'll go at a very comfortable pace and we'll complete all the topics very effectively. Okay.
Done, sir.
All right. Everybody done writing this now? Fine. So now, friends, let us go back to the examples to understand it better. So I will write down example of regular bond. Okay. So shall we now discuss that? I think I've already given you the data earlier. What was the data I told you? Face value was how much? 100 rupees. Life was how much? 5 years. Your coupon rate was 10%. Redemption value was how much? 120. And what was the yield that you had over here? I think the yield was 12%. I told you yield is nothing but investors' expectation. So value of this bond, friends, we already had the issue price also. Issue price is the actual price today. Actual price today. Using the formula, we are trying to find out the theoretical price of the bond, not the actual price. Please be very clear about these two words. I repeat once again, there are two terminologies. One is theoretical price, other one is actual price. Actual price is the price that you see in the stock market. Today, when I Google, I will get this price. Theoretical price is the what should be the price. Entire AFM, we are only trying to find out what should be the price, and then we compare it with the actual price. Everybody clear with this part now? Okay, so just a moment. MHD, you want me to show you the previous slide? Are you all done writing? Okay. I'll go to the next part. So here I'm going to try to find out the theoretical price, or in bracket I will give what should be the price. Okay. So friends, here I'm going to draw a table now. So the table will go like this. Here, cash flow, discount factor, discounted cash flow. So year 1 to 5, I will get a coupon of 10. At the end of year 5, I will get a redemption value of how much? 120. What is my discount factor? 12%. All right. So friends, I need to take the annuity factor. Do you know how to take the annuity factor in your calculator? If you don't know, follow what I'm saying and you should be getting it. Okay. And if you don't get it, let me know. 1 divided by 1.12. That's 12%. We do 1 divided by 1.12. Press into 2 times. Okay. Then you press memory plus. 1, 2, 3. Oh, sorry. Something went wrong in my calculator only, friends. 1 minute. Hold on, friends. Let me just. It's a new calculator that I also have. Into you should do. 3.21. Okay. I'll tell you how we got this. Take your calculator. 1 divided by 1.12. Press equal to memory plus equal to memory plus. Like that, you do it 5 times. Sorry, it's 3.60. Just try it that way. 1 divided by 1.12 equal to memory plus 5 times. That is one of the methods of doing it. Are you getting the answer that way? You should get 3.60. Decimals is okay. Keep it at 2 decimals. That's absolutely fine. One method is that. Okay. Did you get it? Type yes. If you did not get it, type no. I just want to understand whether you got the answer or no. Okay, Ansel has got it. Most of you have got the answer. Anybody who's not got it? Okay, Leah, you have not got it, right? Leah, can you unmute and speak to me?
Yes, sir.
Okay, Leah, try something else. 1 divided by 1.12 press equal to 5 times. 1, 2, 3, 4, 5. Then you will see a button called as GT. Do you see that?
Sir.
I'm not able to hear you, Leah. You will have to unmute and speak to me. That's the only way. I'm not able to hear you.
Hello,
Say
sir.
hi, Leah.
Hi, sir.
Your voice is very, very feeble. Tell hi once again.
Hi, sir.
Okay, this is little better. Are you getting, when you do 1 divided by 1.12, when you press equal to 2 times, are the numbers changing in your calculator or is it remaining the same?
No, sir, it's changing.
It's changing, right? Do you have a button called as GT in your calculator?
No, sir, there's no GT.
Okay, just do 1 divided by 1.12. Just do 1 divided by 1.12. Press equal to.
Okay, sir.
Do you get a number called as 0.892 something?
Yes, sir.
Press on memory plus.
Okay, sir.
Again press equal to.
0.79.
Again press memory plus.
Yes, sir.
Again equal to.
Yes, sir. 0.711.
Fantastic. Press memory plus again.
Yes, sir.
Again press equal to.
0.63.
Fantastic. Press memory plus.
0.56.
Exactly. Now you press memory recall, MRC.
Oh, yes, sir. 3.0.
3.60.
So I got 3.03.
Okay, I think then the last point you forgot to do memory plus. That's a mistake you would have done. When you get 0.56 something, you did not press memory plus. That's the reason you're getting it that way. Okay.
Okay, sir.
All
Thank
right.
you.
Yes. And now, friends, one more thing. Suppose you want the 5th year discounting factor. You just have to do 1 divided by 1.12. Press equal to 5 times. That's all. 1 divided by 1.12. 1, 2, 3, 4, 5. You get 0.567. Just try it out and tell me whether you have got that. Yeah. Learn these calculator skills, friends. Examination hall, you don't need a PV table. You can do it directly from your calculator itself. All right. Fantastic. Now, friends, multiply and tell me what is the answer that you get over here. Here you will get 36. And here you will get 68.04. Do you get the answer as 104.04 over here? Am I right? This should be the, it is not the actual price. This should be the price. Can you write down this in your books now, friends? Once you're done writing, let me know, okay? Please keep your cameras also on. In between, I'm monitoring what you're doing, okay?
Done, sir.
Done? All of you are done? Okay. So, friends, we have got the theoretical price. If anybody is not done, just type ND. I will slow down again, okay? So friends, we have got the theoretical price, but we also have the actual price. That is where we take a decision. So I'll write down the next heading, decision to whether buy or sell. Okay. Now tell me, what is the actual price of the bond today? That is the issue
90.
price today. Is that turning out to be 90? But what is the theoretical price, or what should be the price of the bond? I think we got the answer as 104.4. So friends, the price of the bond should be 104. Right now, the price is only 90. That means the price will eventually go up to 104, or will it fall down? Price will eventually go up. So right now, if I ask you, the bond is overvalued or undervalued? Right now, the bond is undervalued. Hence, what is the action that we are supposed to take? We are supposed to buy. So I'll give you a logic below this. Okay. Price today is 90, but it should be 104.4. Hence, price will go up. Before that, we should buy the bond. Are you all clear with the logic of this one particular thing that I mentioned here, friends?
So,
Yes.
so then what may be the reason to issue the bond at 90 rupees? Why
No,
will
no, no. This is just an example that I have given. In reality, the price will not be 90. The price may be 103, 102, something like that. All right.
okay,
So
okay,
then what we will do, because being undervalued, we will end up buying it. Understood? Okay.
okay, thank you, sir.
Thank you.
Done, sir.
Done, everyone?
No, sir.
Wait. Gopi, you're still writing? Write down, Gopi. I'll slow down. This can work as a balancing figure, friends. Balancing force. I just want my classes to be at par. I don't want to be too fast, neither too slow. Okay. Is theoretical price like a prediction? Arun, yes. It is like, it's not like a prediction, Arun. Maybe I'll put it in a different way. Okay. Everyone interact with me. Okay. Arun Kumar is a very, very hardworking fellow. Every day he studies for 14 hours. Tell me how much marks Arun should get in the upcoming AFM examination. 90, 70 plus, etc. Why do you told this? Because he deserves that based on the actual performance. Am I right? Exactly in the same way, the bonds also have a should have price. But does it mean actually Arun will get 90 marks in the exam? He may get 85, he may get 94. I hope you're understanding what I'm trying to do here. Exactly the same thing applies for a bond also. Okay, Keshava, you have another very good question. Won't the expectation be different for different persons? Keshava, a very good point. Okay. Let me explain this to you. Keshava, if you are putting your money in FD, how much returns do you expect over there?
Around 6%, sir.
Around 6%. Okay. Whoever puts money in FD, can anybody expect 10% or 12% in FD?
No, no, sir.
Why? Because it is risk free. What is a bond? Bond is
Oh.
also risk free. Am I right?
Yes, sir.
So here what happens is your father's business will be a comparison, but their risk will be involved. Risk-free expectation will be the same for everyone.
Okay, sir.
Clear now?
Yes, sir.
Okay. So I believe all of you are done writing these 2 points. Can I go to the next part now? Are you done writing this also?
Yes, sir.
Okay,
Sir.
right. Yes, tell me.
Doubt.
Tell
What
me.
this coupon and yield?
Okay.
Is coupon we expect from the give the return 10%.
Correct.
But you mean by yield?
Yield is, I'll come to that part. I have not explained for time being. I have just told one thing. It is investor's expectation. It is similar to a discounting factor is what I have told you as of now. Okay. But I will explain to you exactly the meaning of yield after I finish the valuation of the bond. Today only we'll explain to you that part also. Okay.
For example, we compute based on the yield rate,
Correct.
not taken the coupon rate means it will
Coupon rate is the actual return that you get from the bond. So for example, suppose NHAI has issued a bond. All right. Face value is 100 and your coupon rate is turning out to be 10%. This means NHAI will pay you how much rupees every year? 10 rupees every year. Does this mean that you should expect 10 years every year? I expect 12% every year. So now tell me, is the bond giving me more or is the bond giving me less? The bond is giving me less. So automatically that will have an effect on the price of the bond. That is what we are trying to intend over here. Are you clear now? I'll give you a few more examples so you become clear on that part. Okay. Let me give you one more example. All right, friends. I'll now give you example number 2. Okay. Let us say face value is 100. I cannot change the face value. Assume the coupon rate is 7%. Let us assume you are expecting a yield of 20%. Redemption value is also 100 and the life is turning out to be 5 years. Okay. So now tell me value of a bond is nothing but present value of future cash flows. Let us use our common sense now. Everyone interact with me. How much is the coupon the bond is giving you? 7%. What is the return that you are expecting from the bond?
20.
In reality, you will not expect more than 10 because bonds are risk-free, but I'm just giving you an extreme example. Okay. 20. So now tell me you are expecting 20. The bond is giving you only 7. Are you happy with the bond or are you unhappy with the bond?
Unhappy.
When you are unhappy, what will you do? Will you buy the bond or will you sell the bond?
Sell.
You will sell. When you sell the bond, the supply goes up and what will happen to the price? Will the price goes up or will the price fall down?
Fall down.
The price should ideally fall down. Am I right? Can we just cross check whether it's actually falling down or no? Let us cross check. I'll write down over here. Year 1 to 5, you will get 7 rupees. At the end of year 500, discounting factor is 20%. Here you will get 0.401 and here you will get 3. So it will be 21, 40.1. Do you get the total of your bond price as 61.10? So price is less than the face value also. Why is it less? Because I'm expecting more and the bond is giving me a lesser return. Can you write down this in your books now?
Done, sir.
All right, friends. Are you all done writing this in your books now? Yes, tell me.
Sir, in the previous question also, the investor expected 12%, which is higher than the 10%. Here
Yes.
also he expected 20%, but there the price went high. Here the price
What was
is
the
high.
redemption price value over there?
Redemption is 120.
120. So aren't you getting a bonus there? Here the redemption value and face value are the same.
Yes.
That is the difference. Okay. So earlier case, not only did you get a coupon
Yes.
of 10, along with that you got a redemption of 120 also.
Yes, sir, understood.
That was an extra bonus. So that's the reason it's actually going up. Understood? Okay. Right. Or I'll put it in a different way. Just interact with me. Here you're getting 120, but the face value is 100. How much is 100 minus 120?
20.
You get extra 20. All right. So when you get extra 20, that is for 5 years, correct? So what is 20 divided by 5 years?
4.
So you get extra 4 rupees per year. Am I right? So actually, instead of getting 10 rupee per year, you're going to get 10 plus 4. So indirectly, you're getting 14% every year. Am I right?
Yes.
14% when you compare with 12%, can I not say that this is better?
Yeah, it's better.
I think you understood what I'm trying to tell you, right? Okay. Let me give you one more example so you become very, very much clear on this. Example number 3. Face value 100, redemption value 100, coupon rate is 10%, yield is only 8%. Now tell me, friends, what will happen to the price of the bond? Or let me take the yield as 5%. What will happen to the price of the bond? Will the price go up or will the price come down? Price will go up. Shall we check it together? At the end of year 5, it is 100, 5%. When you add up these two things, you get the answer as 122. Now the price is more than 100 because coupon is more than your yield.
Sir, then how will my issue price matter here?
Issue price doesn't matter over here. Issue price is only a price that you're going to use for comparing with the theoretical price. That's all.
So here I tend to buy more.
Here you tend to see now this should be the price. Okay, I'll just put it this way. This is your theoretical price. Okay. Now let us assume your issue price was actually turning out to be 130 rupees. Okay. Now tell me, issue price is 130. Theoretical price is 122. Is it undervalued or overvalued?
Over.
So will you buy or sell the bond?
Sell the
Will
bond.
sell the bond because it's already even more than 122.
Yes.
Got it? I just gave you this example to explain to you that if coupon is more than the yield and if the face value and redemption value are the same, your price will ideally be more than 100. That's all that I meant over here.
Done, sir.
Done? All right, friends. So here you can just write down one more point. I'll just put a point over here now. Point number A, theoretical price is equal to 122. Your actual price is how much?
Sir, can you show the
130.
slide?
You're still writing? Okay, wait, let them finish. MHD recordings tomorrow morning by 10 o'clock I will upload, but you have to give me a 24-hour time. Some days, due to technical issues, I might not be able to upload in the morning, so that day we'll be uploading in the evening. 24 hours is the buffer time for arranging the recordings.
Okay, sir.
Are you all done writing this? Okay, fine. I'll go to the next part now. So what did I say here? 1 minute. Actual price is 130. So what is the status over here? Again, it is going to be overvalued. Hence, what is the action that you're going to take over here? You will be selling it. Raining there, MHD, absolutely fine. Please take care. You can attend my class tomorrow. But please don't miss it. Yes, friends, I believe you're all done writing this. Can I go to the next part now? You want me to show you the example 2 slide again? Yeah. You mean this one layer? Please write down. Friends, I hope you are clear with the concept of regular bond valuation. Only one thing I need to explain to you is the yield part. Am I right? Correct? Can I go to the next concept now? Okay. Now I'll give you examples for the other one. That is, we did a regular bond. Now I can just write down a heading called as sub-concept. Valuation of zero coupon bond. Okay. Now give me an example, friends. Let us assume the face value today is 100. Coupon will be how much percentage? Life will be 5 years. At the end of 5 years, let us assume you're going to get 100 rupees. And today, the actual issue price of the bond is 90 rupees. Everyone tell me, value of any asset is nothing but present value of future cash flows. So here, let us find out the theoretical price. So when you do the theoretical price, okay, year 1 to 5, your cash flow will be 0. At the end of year 5, you will get 100. Oh, I forgot to mention the yield. Assume the yield is 20%. So my discount factor will be how much percentage? 20%. This is not applicable. So 1 divided by 1.2. 0.401. 40.1. So everyone tell me what should be the price of the bond? 40.1. What is the actual issue price that is given in the question? 90 rupees. Price is 90, but the price should be 40. Is the price undervalued or overvalued?
Overvalued.
Will you buy the bond or will you sell the bond?
Still.
Sell the bond. So you write down actual price 90. Theoretical price 40. Status will be overvalued, and the action that you will take over here will be sell. Can you write down this in your books and finish it off?
Done, sir.
All right. Everyone done writing or anybody still writing? I believe all of you are done. If anybody is not done, please let me know, okay? Ansel, please write down. Relax and write down. Don't take tension. We'll go ahead only once everybody is done. Fine, friends. I believe all of you are done writing now. Okay. Fantastic. So I believe you are clear with the concept of zero coupon bond. I'll just give you one more example, which I want you to do it yourself. Face value 100. Life, I will keep it as 3 years now. Coupon rate is not there. Redemption value is going to be, let us assume, 110 rupees. Okay. And the yield of this bond is turning out to be 15%. Okay. The issue price of this bond is right now 95 rupees. Come on, friends. Can you find out the theoretical price on your own and tell me whether it is undervalued or overvalued? Can you please do that now? .3 Deepak, that's very good speed. Guru, Pooja, Keshava, everybody got that answer, 72.3 approximately. Let others also finish. I'll just write down. Your actual price is 95. Theoretical price is 32.3. So what is the status? Is it undervalued or overvalued? Overvalued. So what is the action that you will take over here? You will sell. I believe you are all done writing this, friends. Can I go to the next part now? Perfect. So friends, we are done with zero coupon bond also. Now we have to learn about what? Perpetual bond. So first, even before we go into perpetual bond, let us understand how to value perpetuity. All right. Perpetuity means what, friends? Perpetuity means infinity. So how do we work out the present value of cash flows which are going on towards infinity? Shall we start this, friends? In order to explain this, tell me a name of any young, handsome guy in this class. Come on, put any name in the chat box. Gopi, is it? I think we already took Gopi in the previous example, right? Somebody else. Gopi is handsome, but some other fellow also. Any new people? No, Gopi has caught Arun. My dear friends, let us assume, let's not assume, Arun is a young, handsome guy in this class. Okay. So we'll talk about Arun now. Let us assume after my class gets over at 11 o'clock, Arun is extremely hungry and he decides to go to a nearby restaurant. Arun, where are you from? Are you also from Chennai? Yes, all right. So Arun will go to, he's, let's say he's staying somewhere near Nugambakam and he will go to his favorite restaurant nearby to have dinner at night, 11 o'clock, and assuming there are restaurants open at that time. The moment he goes to a restaurant with a hungry stomach, he goes there and is about to order. That is when he will see a beautiful girl sitting in the next table. The moment he sees this beautiful girl, he completely forgets about his hunger and he's completely overwhelmed with the idea of somehow going and communicating with that girl. He is a very, very brave guy. Suddenly, he got courage from somewhere that he got up from his seat, directly went to the next table, and went and told to this woman sitting there that I love you. Will you marry me? Now tell me, friends, what will the girl do? No, no, no. The girl will not slap. Okay. We cannot just give them the right to slap any guy coming on the way. All right. Friends, one mistake that Arun did over here is that he believed in love at first sight. He's just gone there for dinner. He has seen this girl. This girl, unfortunately, was a person who has just come out of an addiction center. Okay. Because she was crazily addicted to dairy milk chocolates. Morning chocolate, afternoon chocolate, evening chocolate, night chocolate, wherever you see chocolates, chocolates, chocolates. So she was somehow trying to find out ways and means of getting these chocolates. That is when Arun is coming and falling right at her feet and asking her, I love you, will you marry me? So this girl will suddenly say, yes. Arun got shocked. The girl has told yes. Now what to do? But she told, I have a condition. The condition what this girl had was she wanted 365 family packets of dairy milk every year on her birthday. Now tell me, my dear friends, what will Arun do? Run, is it? No, Gopi, he's badly in love with this girl. He cannot run away just like that. He has to somehow convince her. So first thing what he will do is, he will take breakup. Suhail, he didn't even start. How will he break up? He will estimate the cost. Satya has got good experience in this, so he will estimate the cost. So tell me, friends, what will be the price of one family packet of dairy milk? Approximately, what is the price of one family packet of dairy milk? Take a loan. Lakshmi, first understand how much loan has to be taken, correct? Then we'll go to the question of taking loan, etc. Berlin says one chocolate of dairy milk is 500 rupees now. Has it become so pricey? I'm not aware of that, friends. Okay, 500 rupees per family packet. Now, how many family packets Arun has to purchase? 365. So please multiply and tell me how much is going to be his yearly investment into this. 1,82,500. Fantastic. Along with this, assume that girl has also demanded some 5-star Toblerone. What are the other chocolates that you have? Oreo or whatever the other chocolates are, which approximately turns out to be 17,500. So now tell me, what is the total yearly outflow that is expected from Arun's pocket? 2 lakh rupees. Now tell me, my dear friends, what will Arun do so that he can afford 2 lakh rupees every year forever towards perpetuity? You can unmute and tell me, or you can send a message in the chat box, however you are comfortable. Rob, Arun, you don't need to rob. Berlin says invest in perpetual bonds. Berlin, first tell me what is perpetual bonds. Then we'll discuss about investing there. Invest, fantastic. Your answer is actually correct. Pani Puri shop, Satya. Pani Puri shop will give you 2 lakh rupees per annum. Fantastic idea, Satya. But it cannot be forever. He will die one day. No. He needs to arrange this money forever, whether he's alive or he's dead. So, friends, I think what Berlin said is actually right. Okay. He will invest, let us assume, 20 lakh rupees in FD. Forget about perpetual bonds for time being. He will invest 20 lakhs in FD at the rate of, let us assume, 10%. Okay. Now let me draw a table here. Opening balance. On that he will get interest, from which he will buy dairy milk chocolate and he will get the closing balance. So year one, he will invest how much money? 20 lakhs. How much interest will he get? 2 lakh. Price of dairy milk? 2 lakh. Closing balance? 20 lakh. Next year opening balance? 20 lakhs. Again he will get 2 lakhs. Again 2 lakhs. Closing 20. This will go on forever. So can I say present value of 2 lakhs at the rate of 10% towards perpetuity is how many lakhs? 20 lakhs. Or how I got this answer is 20 lakhs is equal to 2 lakh divided by 10%. Or present value is equal to whatever is the cash flow divided by what? Divided by the discounting factor. Can you write down till here first and understand till here? Then I will give you the next level. This is not fully complete. This is level 1. Okay. Just write down a little story on your own that Arun met with this girl, he fell in love, then the girl demanded. Should I dictate that? Okay, just write down. Write down. Arun. Arun, what is lagging? I didn't understand. Is there some lag in my voice? Hold on, hold on. Can you all hear me clearly or is there any interruption? It's clear? Arun, can you please restart? I think it must be a lag from your end, Arun. Okay, right. So please write down, all of you. Please write down. Arun falls in love with a mental girl. Who has demanded 365 Dairy Milk chocolates, which is costing how much, friends? 2 lakh per annum towards perpetuity. 2 lakhs per annum towards perpetuity. What should Arun do? What should Arun do so that he can arrange 2 lakhs every year, so that he can arrange 2 lakhs every year forever. Below that you write down, if Arun deposits 20 lakhs, if Arun deposits 20 lakhs at 10%, he will be able to generate he will be able to generate 2 lakhs forever. Now you can put this table in your books. Keshav, I will answer your doubts very, very soon. Friends, are you still writing or are you done writing?
Done, sir.
Done. Can I go to the next part now? So friends, here Keshava actually asked me a very good doubt. Here I have made an assumption that the price of dairy milk chocolate will remain the same forever. Do you think that assumption is correct? In reality, the price of the chocolates will keep on changing. So with 2 lakhs, he cannot afford 365 dairy milk chocolates forever. The price will increase. He has to consider that also. So I'll just give it over here. Situation number 2. Inflation is, let us assume, 5%. So when I say inflation is 5% means if year 1, your dairy milk chocolates are having a price of 2 lakhs, year 2, it will go up by 5%. Please tell me how much is 2 lakh plus 5%? Do you get the answer as 2 lakh 10,000? Year 3, it will be 2 lakh 10,000 plus 5%. How much is that? I need calculator to understand that. Yes. Do I get the answer as 2,20,500? Year 4, it will be this plus 5% again. 2,31,525. Year 5 again plus 5%. It will be 2,43,101. Now tell me, friends, if I invest 20 lakh, will that be enough now? Now, if I invest 20 lakhs, it will not be enough. I have to invest more money now. Okay, so I'll tell you a new formula over here. Okay, present value using perpetuity is equal to cash flow divided by discount factor minus growth or inflation. Everyone repeat with me the formula once again. It will be present value will be equal to cash flow divided by discount factor minus growth. So here, what is the cash flow? 2 lakhs divided by 10% minus the inflation or the growth in the chocolate price is how much? 5%. So what is 2 lakh divided by 5%? Do you get the answer over here as 40 lakhs? Now let us go and check whether I'm getting the same answer over here. All right. So here I will write down here opening balance, add interest, price of dairy milk chocolate, closing balance. Year 1, how much do I invest now? 40 lakhs. How much is 10% of 40 lakhs? Is it 4 lakhs? What is the price of dairy milk chocolate? 2 lakhs. What is going to be my closing balance now? It will be 42 lakhs. Okay. So now tell me how much is the proportion of dairy milk divided by interest income? That's the proportion I'm using. So here I get 2 lakhs. Interest income is 4 lakhs. What is 2 lakh divided by 4 lakh? Can I say 50% is the proportion coming over here? Right? I'm just giving you this to understand how things work out. Year 2, what will be your opening balance? 42 lakhs. How much is 10% of 42 lakhs? 4.20 lakhs. Am I right? What is the price of dairy milk chocolate in year 1? Year 2? It is 2 lakh 10,000. So my closing balance will be 42 plus 4.2 minus 2.1. That is going to be 44.10 lakhs. Now tell me how much is 2.1 divided by 4.2? Do I again get the proportion as 50%? Year 3, 44.10 lakh. 4.41 lakh. What is the price of the chocolate? 2.205. My closing balance will be 46.305, or again the proportion will turn out to be how much percentage? It will be 50%. Everybody clear with this part? Year 4, what is the opening that you have? 46.305. 4.6305. What is the price of the chocolate now? 2.31525. Okay, you keep on doing this. Exactly, you will get the same 50%. Or what is the moral of the story? If I invest, wait, I'll just put the final one also, 48.62025. Year 5, 48.62025, 4.862025, price of the chocolate will be 2.43101. 2.43101. So my closing balance will be 48.62025 plus 10 percentage minus 2.43101, or it will be 51.051265. Again, you get 50%. Or the moral of the story is my interest income will always be double of dairy milk chocolate. Hence, I can afford dairy milk of 2 lakh plus 5% forever. Did you understand the logic, my dear friends? Yes? Okay, now I'll give you some time. Write down and understand these concepts.
Done, sir.
Are you all done? Can I go to the next page? Perfect.
Yes, sir.
Yeah. Arun, is it lagging now for you?
Sir, scroll down, sir.
Excellent, Arun. Good to know that it's cleared now. In Mahesh, yes, that's because of 10% and 5%, it's double. Suppose it was 10% and 8%, it will not be double. It will be that proportion, 10 by 8. That proportion will be applicable over here. Done, friends?
Done, sir.
In case of inflation rate change. Deepak, you have a very good point. What will happen if there is an inflation rate change? Deepak, we are considering the long-term inflation rate. Okay, that's how we are doing it. We will not take the short term. Little bit, if let's say year one it will be 4, next year it will be 6. On an average, we're talking about a 6% inflation rate over here. Okay. Right. So I think we are done with this concept, friends. Shall we take a break now? So we have just learned how to value a bond. That is, value of a bond is nothing but present value of future cash flows. So there we learned 3 types of bond: regular, perpetual, and zero coupon. Okay. After the break, we'll learn about yield. In detail, we'll learn about yield. Thank you, friends. I'll see you after
Can
10.
you show the last part?
Yes, yes, yes. I'm taking a break, friends. I'll get back after 10 minutes. Okay. You write down and you can take a break. Thank you, friends. Friends, I'm back. Yes, shall we resume now? I believe you're all joined back now. Okay. So friends, what we learned before the break was how do you value a bond? Okay. Value of a bond is nothing but it is the present value of future cash flows that the bond can actually generate. There are three types of bond: regular bond, perpetual bond, zero coupon bond. We have now learned the formula for perpetuity. So I think I need to just explain to you. You can just put it as the next sub concept. How to value a perpetual bond. How to value a perpetual bond. Friends, what is the present value of perpetuity formula that I told you over here? The formula is cash flow divided by discount factor minus growth. Am I right? Okay. In the same way, if I want to find out the present value of a perpetual bond, everyone tell me, what is the cash flows that you get in case of a perpetual bond? It is coupon divided by discount factor is what we call it as yield. Minus growth will not come because in case of bond, there is no growth. It is always constant. So this is going to be the formula for a perpetual bond. So I'll just give a note below this. There is no growth in coupon, hence growth will not come in the formula. Can you write down this in your books now? All right, friends. Are you all done writing this? Now we will go to the
Done.
next concept. Anybody still writing? Okay, yield. Friends, I told you yield is nothing but investors' expectation. So friends, what happens in AFM and inter-FM is that students struggle with these terminologies. So I will give you everything in one place. Discount factor means what? Investors' expectation. Yield means what? Bond holders' expectation. KE means what? Equity holders' expectation. KD means what? Debt holders' expectation. VAT means what? Overall investors' expectation. Friends, all these mean one thing. All these are investors' expectation. The only difference is that in each case, investor is different. That's all. Okay. Now, friends, yesterday we learned one more thing. In the long run, discount factor and IRR will be the same. Do you remember that sentence? I told you that in the long run, discount factor and IRR will be the same. Here I will say, in the long run, discount factor is equal to IRR is equal to yield is equal to KE is equal to KD is equal to VAT. Everything is nothing but the IRR only. Can you write down this in your books now, friends? Wait, you want the previous slide? Hold on, hold on. Wait, let them write down this in your books.
Sir,
Tell
in
me.
practical case, the yield means bank rate or
Yield means it is not, it's actually it's going to be somewhere near the bank rate only because it is risk free. Okay.
in practical we cannot how we can calculate the yield rate.
Practically, I think I thought of showing you that in Zerodha, unfortunately, that is not available. That is what I'm going to teach you next. How to calculate yield. There are formulas for that. I'm going to teach you those formulas now. Okay.
Okay, thanks.
Done, sir.
Done. Can I go to the next page now? Sometimes I'll miss out on the messages, so please do unmute and tell me. Okay. Wait, I think you have sent me some link, Mahesh. Let me check that. It's there in the NSE platform directly, is it? Okay. I'll come to this. Let everyone finish writing this. We'll check that. Thank you, Mahesh. Thank you for the link. Are you all done writing this in your books, friends?
Yes, sir. Done.
Fantastic. So I'll now just take the practical link over here. All right. So here you are having different types of bonds. I think most of them are regular bonds over here, is it? Or have I clicked on the regular bond? See, this is one of the bonds. Face value is given. Coupon rate is given over here as 7.6%. And they would have given the indicative yield also somewhere. Last trading price is 1127. This is the issue price, friends. Okay. Price, volume, CRISIL rating, etc. is coming over here. Bond type, let me just see if I can filter it over here. I'm not able to change it. Okay, GSEC is nothing but government securities. That is also one type of bonds only. Let us see if there are any GSECs available. Yes, here also you have an opening price, 99 rupees. Face value is there, but there is no coupon rate that is given. TB means treasury bill. If I click on this, we'll get more details. Let me go back to bonds. Let us click on this bond. Maybe inside this, we'll get an idea. Okay, they have given you what are the details of this bond. They have given you the trade volume information, price information, VAR, value address. We'll learn it in a different chapter. We'll learn it very, very soon. Okay. Here they would be giving an indicative yield normally. They haven't given, they have only given the coupon price, face value, and whatever is the current market prices given over here. So friends, if you want to understand bonds practically, you can come and check all the data in this platform of NSE. But I'm not sure if you can buy the bonds directly in the NSE. Normally, we do it through a broker like Zerodha, Motilal Oswal, etc. Wait, are you all still writing this? Sorry, friends. Are you still writing, Berlin? Please write. Yes, the term yield is used only in case of bonds. It's not used anywhere else. All right, friends. I think you're all done writing this now. Mahesh, Kite platform, I'm not able to see that. Okay, so let's just wait and see. Okay, fine. Let me see if it's there in Motilal Oswal or any other platform. I'll get back to you. Okay. Now, friends, in order to find out yield, I told you we are having three types of bonds over here. Am I right? What is the first bond that we spoke about? We spoke about regular bonds. Then we spoke about zero coupon bond. And then we also spoke about what? Perpetual bonds. Whenever you take regular bonds, inside this you have something called as YTM without time value of money. This is one of the yield. YTM full form is yield to maturity. And the other one is YTM after considering time value of money. Okay. When you look at zero coupon bond, here you are having two types of yield. One is called as bond equivalent yield, and the other one is called as effective annual return. Under this, you have one particular yield, which is called as the current yield. Okay. Okay. Can you please put this overview in your book so I can explain to you the yield based on each of these things?
Sir, what does mean YTM without?
Okay, YTM means yield to maturity. I'm going to explain this one by one in the next page. Okay, this is just the overview. YTM means yield to maturity. TVM means time value of money. All this I will explain to you in the next page. Okay. First put the overview, then we are going to give examples and learn each one of these now. All right, friends. I believe you are all done writing this. Let me explain to you these one by one. Okay. So I will write down the next concept heading. How to calculate yield for regular bonds. Okay. Let me give you an example. Face value 100. Okay. Let us assume the coupon rate over here is turning out to be 10%. You have an issue price of 90 rupees. Redemption value is 110. Life is 5 years. I want to find out what is my yield. Friends, let us understand the logic for the word yield. Yield means what, friends? Yield means whose expectation? Bondholders' expectation. Then I told you, in the long run, yield and IRR will be the same. Are you clear with the concept so far? Please write down till here, then I will go to the next page and explain this to you. Are you all done writing this, friends? I think you're still writing. Let everyone finish. Done, friends? Can I go to the next part now? All right. All right. I'm going to the next part now. Friends, let me explain to this one you once again. Yield is nothing but whose expectation? Bondholders' expectation. I told you in the long run, yield and IRR will be the same. Okay, so you are clear so far, correct? So let me just show you how this works. Here, cash flow, discount factor, discounted cash flow. Year 0, what is the issue price? If I buy the bond at 90, year 1 to 5, I will be getting 10. At the end of year 5, I will be getting 110. I don't know, but at some discount factor, my NPV should be equal to 0 because yield is nothing but in the long run, the rate at which your NPV becomes 0. Okay, so at some discount factor, my NPV becomes 0. That should be my yield because in the long run, yield and IRR will be the same. Okay, just put these things in your books. So then I will go to the next page and I will show you how that actually works out. Done writing, friends? I think you're done with the previous one, not this one. Let everyone finish writing. All right. All right, friends. So I think you're all done with this part. Am I right? Okay. So let me go to the next part now. So here, at some discount factor, my NPV becomes 0. How do we find out this discount factor? We go by the following steps. Do you know steps in IRR I had taught you already? What were the steps coming in IRR, friends? Can you tell me? Step number 1 was what? Initial guess rate. And I had told you at that time, this can be found using what formula I told you? YTM formula. I hope you remember this. I talked to you this yesterday. Then what we will do? We will take the second guess rate. And I told you second guess rate will have a gap of how much percentage? 1%. Okay. After that, what are we supposed to do? We are supposed to do interpolation. Okay. This, when I say YTM formula, this is YTM without considering time value of money. So we are going to start with this one particular thing now. Okay. All right, friends. I believe you're all done writing this. So can I start with YTM without time value of money? Okay. So here we are having YTM. There are two. One is YTM without considering time value of money. Okay. This one is what I call it as approximate IRR. And the other one is YTM after considering time value of money. This is what I call it as accurate IRR. Please repeat with me, friends. YTM without time value of money is what? Is it approximate or accurate? It is only approximate. But after we do the second guess rate, etc., we get the accurate IRR. That is called as what? YTM after considering time value of money. Please draw this chart in your books. All right, friends. Now I'll start with step number 1, that is to get the initial guess rate. So I'll write down YTM without considering time value of money. Friends, this formula you have learned at your intermediate level, and this formula was called as the approximation method, if you remember that. Otherwise, forget it, I'm teaching you the same formula again. So this is equal to coupon amount plus redemption value minus issue price divided by life whole divided by redemption value plus issue price divided by 2. Or how much was your coupon amount in this example? 10 rupee plus redemption value is 110 minus issue price divided by life is 5 years whole divided by 110 plus 90 divided by 2. Or in other words, 10 plus, I think 20 by 5 will be 4 divided by 100. Do you get the answer as 14% over here? Logic, I will tell you. First, you write down this formula and think what is the logic of this formula.
Done, sir.
All right. Now let me explain to you the logic of this. Okay. Did you get the answer as 14%? Okay. Anybody who got the logic, can you please unmute and tell me if anybody has understood how these numbers are coming? Anyone?
Yes, sir.
Please tell me.
So basically what we are comparing is how much is the annual return which we'll be getting by investing in this bond.
Okay.
And in the denominator, we are just considering the average of opening and closing price.
Fantastic, Deepak. You have told it very, very well. Let me explain the same thing once again so everyone can also get a grip on this. But good job, Deepak. Keep it up. Friends, we are always talking from whose point of view? We are talking from investor's point of view. Okay. So when I'm speaking from an investor's point of view, he will look at two things. One, he will look at how much is the investment done. Two, he will look at what are the returns generated. Am I right? So friends, here as an investor, today opening, how much money am I investing today? 90 rupees. At the end of 5 years, how much money am I getting back? 110 rupees. That is my closing value of my investment. So basically the value has appreciated over the period. Correct? So when I look at these two numbers, can you tell me What is my average investment over here? 100 rupees becomes my average investment. Okay. Now, when I look at the return generated, I get coupon per year. How much is the coupon amount I get per year? Sorry, I think I'm getting 10 rupees per year. Same way, I am also getting capital gains. I'll convert that also into per year. At the end of 5 years, I get 110. Today, I'm investing 90. So my capital gain turns out to be how much? 20 rupees, but that is for 5 years. So per year, does it turn out to be 4 rupees per year? Now, what is my total returns which I get over here per year? That will be 10 plus 4. That is equal to how much? 14 rupees. Okay. So I am getting 14 rupees return on my investment of 100 rupees. So when I take it this way, how much is 14 divided by 100? I am getting 14% returns. Now tell me, if my father was giving me 15%, will I buy this bond? No, I am buying this bond because my father is giving me less than or equal to 14%. Hence, 14% becomes my expectation. So I'll just write down below this. If my father gives 15% return, I won't buy the bond. Full stop. I am buying it today because father is giving less than or equal to 14%. Hence, 14% becomes my approximate expectation. Why do I call it as approximate? Because it is not an accurate IRR. I'll come to that part later on. Can you write down this logic in your books now, all of you? They will explain to you. Let everyone finish writing this, then I will re-explain to you. All right, friends. I think you're still writing, correct? Or are you done writing? Where are my support people?
Done, sir.
Done, Shivkumar? All right.
Yes, sir.
Gopi Krishna, you're still writing, is it? Please write down. Some of them are still writing. Let them finish, friends. Fine, friends. I think all of you are done writing now, correct? Okay. Now, friends, I think somebody had a doubt on the capital gains part. Sridevi, can you please unmute and tell me a hi? We can have a discussion live on that.
Can you hear me, sir?
Yes, Sridevi, can you hear me?
Yeah, I'm traveling. You might hear a little bit of sound.
That's okay. You're audible. You're audible. Sridevi, today if I buy the bond, how much money I have to pay for the bond?
9.
90. Okay. At the end of 5 years, when I sell the bond, how much will I receive back?
110.
110. So that means when I'm selling it, I'm actually making a total capital gains of how much over here? Am I making 20 rupees?
Yes.
This 20 rupees is coming in a span of how many years? It is coming in a span of
5 years.
5 years. So per year, can I say if I do 20 by 5 on an average per year, you get a capital gain of 4 rupees?
Yes.
Correct? This is coming along with 10 rupees. So when you add up 10 plus 4, your average return per annum turns out to be how much? It turns out to be 14 rupees per year. Are you all clear now, friends? All right. Yes. So friends, I told you now this 14% is it approximate IRR or accurate IRR? This is actually approximate. So this is step number 1, initial guess rate. Now shall we go and take the second guess rate? Come on, friends. You tell me if 14% is the first guess rate, what will be my second guess rate?
15.
15 or 13, depending upon what is your NPV. If NPV is positive, you will take 15. NPV is negative, you will take 13. All right. So I'll do one thing. I'll write down the next working note heading, interpolation. So here I'll draw year, cash flow, discount factor at 14%, discounted cash flow. Year 0, 90. Year 1 to 5, you're getting 10. At the end of year 5, 110. Okay. Then after this, I will take either 15 or 14, depending upon whatever I get over here. Can you write down this and tell me how much is the NPV that you get over here? I think you get the NPV as plus 1.4. Now tell me, if NPV is plus, what is the next thing that I'm supposed to do, friends? I'm supposed to take a higher discounting factor. Am I right? So I will have to take 15%. All right. Did I do some mistake here? $3.35. I will get minus 1.83. Now I should do an interpolation. Am I right? So the first one is turning out to be how much? 14%. Second one is 15%. Okay, here I'll put plus 1.4. Here I'll put minus 1.83. So the overall gap over here will be how much? 3.23. I am looking for an NPV of 0. So the gap here is 1.4. So my formula would be what? It will turn out to be 14% plus 1.4 divided by 2.83. So I will get the accurate IRR as how much, friends? 14.43%. This is going to be my YTM after considering what, friends? After considering time value of money. This is how we work out the yield. Beautiful, lengthy question. So we'll spend some more time on mastering this part. Okay, please write it down. Friends, are you all done writing? Perfect. All right, friends. So I think all of you are done writing this. Yasin is
sir.
still writing. Please write down. Let me slow down a bit. All right, friends, I believe all of you are done. Are you clear with these concepts now? Okay, let me do one more problem on this one so that we become thoroughly clear on this. Are you ready, friends? Now we'll do it a little faster. I will give it as example number 2. Okay, now let us assume face value 100. Issue price, will take it as 95. Redemption value, we can keep it at 100 itself if you want, or I can take it as, let's keep it as 120. Coupon rate, let us keep it at 12%. YTM is what I need to find out. So tell me, friends, what is going to be step number 1 that I need to do? YTM without considering what? Time value of money. So what is the formula for this one? Everyone tell me. Coupon amount 12 plus redemption value minus issue price divided by life. Let us assume the life is 3 years. So divided by 3 whole divided by 120 plus 95 divided by 2. Can somebody please solve it and tell me what answer do you get over here? I think you get 15 by 3 will be 5. That's 17. 17 divided by 107.5. Am I right? So what is 17 divided by 107.5? Do I get the answer as 15.82% over here? Now tell me, is this approximate IRR or accurate IRR? This is going to be approximate. So now I will go to step number 2, where I will find out YTM after considering time value of money. Okay, here cash flow, discount factor, discounted cash flow. Year 0 you pay 95, year 1 to 3 you get 12, at the end of year 3 you're getting 120. The discounting factor is how much percentage now? 15.82%. So it will be 1 over here minus 95. 0.643 will come here and 2.25 will come over here. That will be 27 and here it will be 77.16. 104 minus 95. I think you will get a very big gap of plus 9.16. Have I done this correctly, friends? Just confirm, okay?
So it is 18.91%.
Did I take a wrong percentage here?
Yes, sir.
Sir, 120 minus 95 is 25, not 15.
So
Oh,
it
that's
is
25
The
20.33.
that's
numerator is
8.33.
actually 20.33.
Okay, okay. Thank you. Thank you for correcting me here. 20.33 divided by 107.5 will give you 18.91%. Okay, all right. All right. So then I'll just come back over here and what I'll do is, if you have got 18.91, it should be around, I'll put it at 18.91%. And let me change the PV factor. .594. And here you will get 2.14. So $71.28. So that would give you the answer as minus 95. Correct? I think you'll get the answer as plus 1.96. So then I will take the next discounting factor, that is 19.91%. 0.580, 1.27. That is going to be 95 here, 15.24 over here, and 69.60. Did I again do it correct? I made some mistake. Discounting factor is not correct.
For 1 to 3 years is 2.1.
2.10. Okay. 2.10. $25.31. 94.91. So that is almost zero here. Am I right? Minus 95 will be minus 0.09. So your answer would be, you will take 18.91% plus 1.96 divided by 2.05, the sum total of this. 0.95 plus 18.91, that is 19.86% is your accurate IRR. Please write down this and understand this thoroughly, friends. I don't think we have time to cover anything more. I'll give you one more example that you will solve it yourself now, and we'll pack up today's session. Can I go to the next page, friends? Are you all done? Friends, are you all comfortable with the pace right now? Or should I slow down a little bit? Please type and let me know. Or should I speed up? Whatever way you're comfortable, let me know in the chat box right away. Now you can personally message me if you want. Okay. All right. I'm going to the next page. If you are still doing, let me know. I will slow down. Yasin, the recorded classes we are uploading in the app, but I think many haven't got access, so that's okay. It will take some 2 to 3 days of time. Until then, I'll arrange some unlisted access in YouTube, or somehow I will make sure that you get the access. Don't worry at all. After the app access is given to everyone, I'll remove the videos from YouTube. Okay. So don't worry, none of you will lose out on the access. Yes, yes. All my live classes will be in Zoom itself, but the Zoom is integrated with Class Plus. So ideally, when I go live there, you can watch it live. Okay, but it will be in Zoom only. The platform will be Zoom. Are you still writing, friends? Or are you done writing?
Done, sir.
Perfect, perfect, friends. So I think you're all done writing this. Time is almost 10:45, friends. I don't think we'll have time for you to work out one more question. Can I give you a homework question? Can you try doing it and coming back tomorrow? Okay. Right. I'm just giving you one homework question so that you become clear with the concept. Let's give a face value of 100 rupees. Issue price, let us take it as 80 rupees now. Redemption value, I'll stick to 100. Let us say the coupon rate is going to be 8%. You need to find out the YTM, and let us assume the life is going to be 5 years. All right. Just try working out this question yourself. Okay. So that you get a grip on what we have done. It's just a repeated question so that you get expertise, and exams also questions come just like this. So once you do this, you get very good confidence. Okay. So first you do YTM with formula method, then you do IRR method. Okay. One more point, let me just give you before I forget. In exam, YTM can be solved using formula method. We need not do interpolation. Just give this as a note before you give this question. Okay. All right. Perfect, friends. So I believe you're all clear so far about whatever we have done. Okay. I'll quickly pack up my session with one inspirational story about this one person whose name is Chanil Usman. He's a popular faculty today, friends, in Kerala. One time he was my student, and I just want to share with you how doing the assignments, or how 2 times without looking actually helped him in his career. Friends, I told you yesterday that every question that we work out, okay, when you get the time on Sunday or Saturday or Friday, please work out all the questions how many times without looking? 2 times without looking. That's very, very important, because if you do it in class one time, it has a 30% impact on your mind. When you do it the second time, it becomes 60%. You do it for the third time, it becomes 90%. And after that, chances of you forgetting this subject will become very, very less. So friends, exactly by investing 3 hours daily, suppose I'm taking from Sunday to Thursday, 5 days, I'm doing some number of problems. If you sit on a Friday, you can do all the problems one time. Saturday again, you can sit and do it one time. you become a specialist. Shanil was one of my students back in 2000, I think 12, 13. That's almost 10, 12 years back. Friends, at that time, I used to monitor everyone. I used to go and check whether they have done their homeworks properly or no. Shanil was one of those students, friends. Your class used to be early morning, 7 o'clock to 9 o'clock. Every single day, he will reach the class by 6:50 a.m. Every single day, consistently. He used to do all his assignments consistently. I have seen people getting distracted or deviated, but Shanil was one person who never got distracted. He always was disciplined. He did his part properly. In fact, because of that, he used to ask some doubts in the class, and trust me, the quality of doubts that he used to ask was very, very difficult. Many a times I had to struggle to answer him back. So I used to tell him that I'll go back, check, and get back to him. That way, there were many days also there. One thing was sure, that attempt, Shanil would have easily scored 85 plus in SFM. Now it is called as AFM. That time it was called as SFM. Friends, when the exam started, that is the FR exam got over, I am getting a message from Shanil Usman stating that he is having very high fever and he may not write the upcoming SFM examination. I was really shocked and surprised to hear that from him because I was hoping that he would get a rank. I asked him, Shanil, what happened? Why are you saying this? He said, I'm down with high fever. I think he had around 103, 104 degrees of fever and he couldn't get up from the bed. I told him, Shanil, you have anyways written FR. Just go write your SFM paper. It's okay if you don't even clear. At least you will get an experience of going, sitting and writing that examination. Those 2 days, he did not touch his SFM book. He was on Dolo 650, bed rest the whole time. Those 3 hours was the only 3 hours he got up. Somehow he went to the examination hall and he wrote the exam and he came back. Friends, by the time was around 5:30, I get a call from Shanil and he was telling me that, sir, those 2 times that I wrote down was very, very useful because I couldn't touch my book one day before the exam. I was blank when I entered the examination hall. I thought I will fail. But the moment the questions came, answers flashed in my mind automatically and I was able to write. Even though I couldn't attempt the whole paper, I have written around 70 marks and whatever I have written is correct because I remembered exactly the same thing being done in the class. Friends, in that attempt, Shanil Usman scored 48 in SFM and that attempt he actually became a chartered accountant. So friends, when I told you to write down these assignments twice without looking, it has a very, very serious impact. We have to understand that you are now at the CA final level. At this level, your ideas, thoughts, concepts have to become automatic. And the only way it is possible for these thoughts to become automatic is only when you do the same thing again and again and again until it gets in your subconscious mind, after which it becomes your permanent memory. And with that expertise, if you go to the examination hall, I promise you, friends, it is very, very easy to pass this exam, provided you have done this level of hard work. So it is my genuine request to all of you, please be consistent in the classes and work out every question in my material that I'll share with you 2 times without looking. Because once you do it twice, I assure you that it goes inside your subconscious mind and you will remember it, you will write in the exam and you will see the results what we both have dreamt of yesterday of scoring more than 70 marks. Thank you so much, friends. Let's pack up our session with this. I will see you tomorrow at 8 p.m. Have a nice time ahead. Take care. Good night, everyone.
Thank you, sir.
Thank you.
Thank you, sir.
Thank you. Good night.
Thank you, sir.
Thank you.